Hello and welcome back to Mergerverse. And so today we'll continue with our M&A Tax course, and in this which is part one of how private equity funds work. So as you are aware, M&A Tax works a lot with private equity funds being investing into portfolio companies or private equity funds being set up. And so in this first part, we'll briefly touch upon how a private equity fund is structured. So let's start. So what exactly is a private equity? So as the name suggests, private equity, basically a private company or private pool of capital investing into equity shares, and generally of unlisted or private companies which are not publicly traded. The private equity firms generally pool capital from various groups of investors or alternate high net worth individuals and other kinds of family offices, pension funds, and endowments, and pool those funds and then invest into various businesses. There are various kinds of private equity funds like buyout funds. So buyout fund will completely acquire the business and will take over that business. Venture capitals, which if you would have heard, are funds which back early stage startups, are probably ones that provide the early capital for high risk companies. Then you have debt credit funds which invest in debt or provide more debt funding, and then you have LBO funds or leverage buyout funds which basically use borrowed capital using leverage to acquire companies. So basically they don't invest a lot of their own personal capital but take loan, and LBO is something that we will cover separately in a later video. But a famous example of LBO is acquisition of Manchester United in 2005. We would love to search about what happened there and why it is so controversial. Now, some of the big leading players in the industry, so in terms of the global giants, KKR and Blackstone are kind of the biggest PE funds in the world. Then there are other funds as well. There are many funds. In India, there are some new homegrown funds that have grown, like Kedara Capital, Multiples Asset Management, and others. And there are various kinds of, as I said, various kinds of PE funds in India and in foreign countries also, which invest into India. So now in this video, we'll talk about the structure of how private equity funds are, how they get the money, and how they invest into the target company. So as we discussed earlier, private equity funds pool money from various kinds of investors. They include high net worth individuals, pension funds, endowment funds. So typically they will create a master fund which will pool money from all these investors. Now this master fund is generally created in Luxembourg, Cayman Islands, or British Virgin Islands, basically where there is not a lot of transparency on data, and there's a lot of secrecy. So this is so that it is kind of disconnected, because a lot of the investors into private equity funds are generally from the US or from European countries, and they don't want to be categorized as taxable in US or other European countries, and so these are generally set up in Cayman Islands or Luxembourg or BVI. But as we know, Cayman Islands and British Virgin Islands don't have a very good reputation. So these entities will then create sub-funds, and these sub-funds will generally be created in more reputable countries. Now Luxembourg is an exception in the first three, because Luxembourg has a good reputation. So Luxembourg can be a good place for master fund, but if you are not investing into Europe, then you will not go into Luxembourg. So Cayman Islands or British Virgin Islands are generally where most of the US funds create their master fund. Now after this master fund is created, then there will be a secondary or sub fund will be created. Now why is this sub fund created? So the master fund generally pools the money from all the investors, and then this sub fund is specifically going to go into for specific investor groups or specific sector, and sometimes private equity funds will onboard other co-investors into their structure, so they don't want to mix both of them. So for example, you have taken funds from various investors and now you're going to invest into, let's say, infrastructure deal, And now another person has said, and they come out and said that for a specific deal, he also wants to be part of it, or for a specific reason, he wants to co-invest with you, but not for your overall fund structure. So you introduce him in the sub fund level instead of the master fund level. And also this allows for the distribution of the fund, returns of the fund to the original investors at the master fund level much easier. Then once this sub fund is created, now below this an investment fund is created. This is basically created specifically for one investment. So for let's take an example, a private equity fund wants to fund in an infrastructure company in India. Now it has created a master fund in let's say in Cayman Islands. Then it will create a sub fund most likely in Singapore or Mauritius for investment into Asian entities, and then it will create a investment fund or the main entity that will hold the shares of the target company in India, and this will again be either in Mauritius or Singapore, depending upon the tax depending upon the preference generally. Now we know why Mauritius or Singapore would be preferred over any other country, although there are no longer treaty benefits left, but there are still certain other benefits that are there, and we'll cover more about the tax aspect in India in later part of this, and we have covered some of this in our previous video, specifically in the Tiger global ruling video, so do watch that one as well. But generally this is how it will be structured, and once that investment fund is created, it will then invest into the target company or acquire that target company shares depending upon how many shares it wants to acquire. Now this is mostly the typical fund structure. In some funds, generally based in Europe, you will find a 3-tier structure below the investment fund. So once that main investment fund is created for that specific entity, they will then create a topco, midco, bidco, and then target. That is mostly very common in European deals. Now the reason for this creation of topco, midco, bidco is to further protect from insolvency and other legal risk. Generally, these topco, midco, and bidco are created in the country in which the target is located. So if we consider, let's say your NPE fund is investing into a company based in UK. So the investment fund might be in Luxembourg, but then it will create a topco, midco, or bidco in UK, which will invest into the target company based in UK. This is more common in UK deals because UK tax is based on residence, and these companies will be unlikely to have any income other than the return on the investment, and generally that return would be made by bidco, which will go to midco and topco and then to investment fund. So generally it will only be taxed once at the bidco level, but it is dependent upon the tax laws of that particular country. Now the main reason is obviously the legal risk or insolvency risk. There is also tax and reporting laws. So again, in various European countries, you can get some more leniency in reporting in comparison to other countries. And as I said, there are certain countries which tax only based on residency. So, and there are other aspects of tax, like in Singapore, if a company pays interest to another Singapore company, there is no withholding tax requirement. There are similar tax angles in other jurisdictions. So that's another reason for why companies may consider this structure. Now, for your homework for this part 1, research some of the major PE deals that happened in 2025. You need to note down which fund invested into which target company, what was the deal size, and which entity or which jurisdiction the PE fund was investing from. Also, you will see a lot of those deals are between PE funds. So one PE fund is selling to another PE fund, and those will make things very interesting. Now in the second part, we'll go deeper into the tax and substance considerations for India focused PE funds. Thanks for watching.